So Congress just slipped in a brand new tax break in the big beautiful bill that lets you write off the interest on your car loan. Yep, you heard me right. Starting in 2025, Uncle Sam is giving you a temporary tax deduction just for financing a brand new vehicle. And under section 70203 of the big beautiful bill, this tax break is only available for a limited 4-year window from January 1st, 2025 to December 31st, 2028. This one is sneaky because it looks like a good deal on paper, but if you're not being careful, it could trap you into paying thousands more in car debt than you will ever save in taxes. So let's break this down the way I would if we were sitting across the table, because this is something you absolutely need to know about. So, how does this whole thing work? Let's take a look at section 70203 of the Big Beautiful Bill. First off, this is not a permanent change, it's a temporary rule that lasts for 4 years, and it kicks in on January 1st, 2025, and it rides off into the sunset on December 31st, 2028. So, we've got a 4-year window to work with here. And this car loan interest write off is also considered an above the line deduction for anyone who is not a tax nerd. Let me tell you why that's fantastic news. It means you get to take this deduction whether you itemize or not. You can take the full standard deduction that most people take these days, and then you get to deduct your car loan interest right on top of it. And you do not have to choose one or the other. It's a straight reduction of your adjusted gross income, or AGI, which is the number the IRS really cares about. And of course, they didn't just give us a blank check. There are limits. The maximum amount of interest you can deduct in any given year is capped at $10,000. And let's be crystal clear about something right here, because this is where a lot of people get tripped up. This is a tax deduction, not a tax credit. And they sound similar, but they are worlds apart. A tax credit is like a coupon that you get, which reduces your tax bill dollar for dollar. $1,000 credit saves you exactly $1,000. A deduction, on the other hand, just lowers the amount of your income that gets taxed in the first place. The actual cash you save depends on your marginal tax bracket. And let me break it down with some simple math. Let's say you manage to pay the full $10,000 in car loan interest in a year. If you're in the 10% marginal tax bracket, that $10,000 deduction will save you $1,000 in actual taxes. If you're in the 12% bracket, that same deduction saves you $1,200. Jump up to the 22% bracket and you're saving $2,200. And if you're in the 24% bracket, you will save $2,400. So the more you make and the higher your tax bracket is, the more valuable this deduction becomes up to a point. And keep in mind that you can only get a federal tax deduction and not your state tax deduction if you live in a state with a state income tax. And that brings us to the next classic government feature, the phase out. And you didn't think everyone would get the full benefit, right? And of course not. They have built in an income limit, and the phase out is designed to reduce the deduction for higher earners gradually. The way it works is your maximum $10,000 deduction is reduced by $200 for every $1,000 in income you earn above a certain threshold. For a single individual, that phase out range starts at $100,000 and ends at $150,000. For married couples filing taxes jointly, it's double that, starting at $200,000 and ending at $250,000. Let's put that in plain terms. If you're a single filer making under $100,000 a year, congratulations. You can enjoy the full $10,000 interest deduction, assuming you pay that much. The same goes for a married couple making under $200,000. You guys are in the clear. However, once your income crosses that line, the benefits start to shrink. And if you're a single person making over $150,000 or a married couple making over $250,000, then I'm sorry to say this deduction is not for you at all. You get nothing. Let me give you a few examples so you can see this in action. Say you are single and you make $120,000 a year. Your income is above the $100,000 threshold, so you're in the phase out zone. To figure out how much you lose, we first see how far into the range you are. 120,000 minus $100,000, so you're $20,000 over the line. The total phase out range is $50,000 wide from $100,000 to $150,000. So we take your $20,000 and divide it by the full $50,000 range. That gives you 0.4, which means you lose 40% of the potential deduction. We take the maximum $10,000 deduction and multiply it by 40%, which is $4,000. and that's the amount you're not allowed to take. So your maximum deduction in this case is reduced from $10,000 to $6,000. Now, let's say you're married and together you make $230,000. Your threshold started at $200,000, so you are $30,000 into the phase out range. The total phase out range is $50,000 wide from $200,000 to $250,000. Just like before, we take that $30,000 and divide it by your $50,000 phase out window. That gives us zero point 0.6 or 60%. That means you lose 60% of the deduction. So 60% of $10,000 is $6,000. You have to subtract that $6,000 from the maximum, leaving you with a potential deduction of just $4,000. It's a bit of math, but it's crucial to know where you stand. Now, before you get too excited and start thinking about that new truck, hold on a minute. Not just any car loan qualifies. And first, the car has to be purchased between January 1st, 2025 and December 31st, 2028. The car loan also has to originate within the same 4-year window. Now, what if you refinance? The IRS actually addressed this, saying if a qualifying vehicle loan is later refinanced, interest paid on the refinance amount is generally eligible for the deduction. That's good news. It gives you some flexibility. To make it all work, banks and lenders will be required to report the total interest you paid each year, probably on a Form 1098, just like they do with Ford mortgages. And one word of caution though, you cannot get clever and refinance your car loan into a personal loan and still claim the deduction. It has to be a secure auto loan. The next requirement is a big one, and it has to be a brand new car, and it has to be for personal use. No used cars allowed. And I'm not a fan of buying new cars unless you're completely debt free and have enough income to justify it because of how fast a new car can depreciate in value. But that's a topic for another day. And here's another major hurdle. The car must have its final assembly in the United States. No surprises there. They are trying to incentivize domestic manufacturing. So to verify this, the dealership is required to provide an information label on the vehicle that clearly lists the final assembly location. If you cannot find it for some reason, you can always look up the vehicle identification number or the VIN number. The first digit of the VIN tells you the country of origin. A 1, 4, or 5 means it was assembled right here in the USA. The list of eligible vehicles is pretty broad. It includes cars, minivans, vans, SUVs, pickup trucks, and even motorcycles, as long as they weigh less than 14,000 pounds. What's not on the list? Things like ATVs, trailers, campers, and again, used cars and any vehicles assembled abroad are not eligible. So you have to be careful and check all the boxes before you sign on the dotted line. So the big question is, who really benefits from this? Is this a game changer? Let's run the numbers on a typical scenario. At the time I'm recording this, the average interest rate on a new car loan is around 6.7%. And the average price for a new car, it's a staggering $48,000. If you take out a $48,000 loan at that rate for a 60-month term, your total interest cost over the 5 years will be about $8,600. And in the very first year of the loan, you will pay about $2,975 in interest. Now, if you're in the 22% tax bracket, that $2,975 deduction will save you about $655 on your taxes. Let me say that again. You save $655. Now, is that nice? Sure. But let's look at the other side of the coin. To get that $655 tax break, you're signing up for a monthly car payment of around $944 over the course of a year. That's over $11,300 in payments. So you're shelling out over 11 grand to save 655 bucks. Is it really worth it? In my books, absolutely not. The most you could possibly save in a year is $2,400 if you're in that 24% bracket and somehow paid $10,000 in interest. That's just not a trade that makes financial sense. And look, I will be completely honest with you guys. I used to be that guy. In my younger days, I got into so much car debt, it would make your head spin. And I just had to have that new car every 3 years, and I was chasing the status to smell the technology, right? And I was completely blind to how much it was costing me, and not just in payments, but in lost opportunity. It was a vicious cycle of debt that kept me from building any real wealth. And I broke that cycle a long time ago, over 10 years ago now. Instead of financing a new car every few years, I buy a good, reliable used car and I drive it for 10 years or even 15 years. And that money that would have gone to a car payment, I put it to work. I took that impulse and decided to invest $300 a month into a simple low cost index fund. Let's say you get an 8% average annual return, which is historically very reasonable. That $300 a month doesn't just disappear. In 10 years, it turns into over $52,000. In 15 years, it grows to nearly $97,000. Now, that's a car. A car you can walk in and buy with cash, free and clear, with no interest payments eating away at your future. So here's my final take on this new tax rule. If you went out and bought a qualifying new car recently, then by all means take this tax break. It's a small silver lining that can help you out temporarily until it expires at the end of 2028. But don't let it fool you into thinking car debt is good debt just because you can write off the interest. It's a trap. Almost every car you buy is a depreciating asset. It loses value the second you drive it off the lot. Paying interest on top of that depreciation is like pouring salt in a financial wound, and it would still hurt your finances. My best advice has never changed. Get out of debt, stay out of debt, and invest in your future instead. And you can always schedule a 60-minute consultation with me by visiting firestrategy.com/consultation to get out of debt as soon as possible. And this has been another beast of a video, and I hope you got a lot out of it.